Hello, everyone. Welcome to another edition of the Coach's Playbook. Today, we're joined by some of the usual suspects: John Hoagland, Dan Hodgman, Mick Aronimo. I'm a, I'm JD, and I'm going to do my best to fill in for Jack today, who I believe is presently attempting to drive over the Mackinac Bridge in northern Michigan, which anyone who's ever made that drive in turbulent weather can tell you it's nothing short of terrifying. None of you guys ever tried it?
I've done it in the winter before with a big snowmobile trailer in the middle of a blizzard.
I went across the Golden Gate Bridge on a motorcycle in fog.
Oh, that's fun.
The fog was going sideways while I'm trying to go forward, and I can only see about 10 feet in front of me. It was one of the most disorienting things I've ever been on.
Well, we know you're a risk seeker, John.
Yes. Yes. I'm like, don't fall off the bridge. Don't fall off the bridge. Don't fall off the bridge.
Right? I know on the Mackinac Bridge, they actually have people on either side that you can hire to drive your car across because some people
Get
get so
out.
nervous they lock up on the road and just stop their car.
Holy
I've
smokes.
heard that.
Sounds like they should have designed the bridge a little bit differently.
Well, anyway, let's bridge this gap over to divergence, which is our topic for today. So, in a nutshell, divergence is what happens when price and an indicator or another market, like a moving average or a momentum oscillator, begin sort of moving away from each other or in opposite directions. But before we get too deep into that, Mick, I think you got a shout out for us.
I do have a shout out. Shout out to Marlon Haynes. He's up about 1900 right now, trading the Nasdaq. He's been on a tear. Building his account very nicely lately. So big shout out to him. He's one of my favorite guys to work with. While he's in the funded account.
He's been with us for a long time.
Yes, he has.
Absolutely. He's been having a nice month here so far.
Yeah.
Very nice.
Seems like he's progressed quite a bit in his trading, just getting better and better. So really happy to see that.
Oh, that's great. Big shout out to you guys. Congratulations, everyone. Keep working at it. So, in a nutshell, when a divergence occurs, then we're typically going to be looking for the strength in a market is moving in a particular direction to start kind of weakening or change direction. We all know the market is still going to do what the market's going to do. Earlier this year, we watched the stock market melt up in the months leading up to the February crash, and nearly every momentum oscillator out there was implying overbought conditions. Now, Mick and Dan, I know you both have strong backgrounds in technical analysis. What would you say the rules are for waiting out the market change? You know what, let me rephrase. Uh, Timing your setup when a divergence is occurring, but the market isn't correcting.
Good broad question, John. I like it. So as far as momentum goes, it's something that people using technical analysis might utilize. You have a couple different oscillators that will show you momentum: RSI, the residual strength index, as well as your stochastics. The nice thing about gauging momentum off of these indicators is it can be applied to a short time frame, also a high time frame too, whether you're looking at a daily, a weekly, or a monthly chart. So you can utilize it based on your strategy in the time frame you're trading on. People will, you have, it's a tool that you can use where you obviously have price that you can monitor, but you can also monitor momentum. A certain way you can use this tool is to compare price action and that going up or down in price, and then size that up against momentum. There's the terms buy divergences and sell divergences. I personally like using some stochastics. I like using these for the momentum. I find it to be interesting when you might see prices making new highs where you don't have the momentum making new highs, or prices making new lows, and you don't see that out of the momentum. It gives me something to look at. It's nothing that I blindly make decisions off of, but as you catch that and notice it, you can use it to interpret what you might think the market's doing, whether we've just made new highs and you think that the rally might fail, or we've been breaking lower and you think hey, maybe this is starting to, this could be a bottom area. And like I said, whether that's on a 5 or a 15-minute chart or a daily or a weekly chart, it's a really good tool. And I'll be upfront. Weeks ago we talked about moving averages. There's a lot of indicators out there. The main ones that I keep on my charts are a couple moving averages and then a couple stochastics. So I find I like using those. I like to keep my charts simple. There's a lot of stuff you can throw on there, but these are valuable to me and other traders.
Great points, Mick. Thanks. I know we were talking a little bit before we even started about correlations between different markets too. And Dan, you had something to say about that also.
Absolutely. It's always correlations is something that I've used a lot. It's something as a treasuries trader, we were looking at gold, we were looking at equities to try and get an idea of where the bonds might go. But another one that's been really interesting over this last year that people have paid attention to is the treasury yields. We're watching those treasury yields earlier this year. JD was just talking about, we had so many indications saying, look, this market's overbought. We saw treasury yields dipping extremely low, hitting all-time lows in those markets. And you could hear it everywhere that everyone was looking for equities to start to break. And this was going on well before the break even began. This was going on in the tail end of last year, even the last half of last year. And we started to see those treasuries breaking down and we saw equities continue to move up. There's a slight divergence there. Things are telling us something's going on here and we have to start to look for that opportunity of when this break's going to come. Something that I've really paid attention to is to see when you look at equities, you think you've got the Dow, the NASDAQ, the Russell, the S&Ps, they tend to all move in a very similar direction. If you see one start to go, that's kind of that leading indicator that the others are going to want to follow. Obviously, current conditions, things are a little bit different. You've got stuff like Tesla and Apple surging to new highs, Apple $2 trillion company. So these large cap companies are kind of bringing a lot of these markets up where you see the Russell, which are some of these small cap companies, that's where they're struggling. And so it's starting to create a little bit of divergence there. Now things are going to start to change as Apple starts to split, as Tesla has a little bit of a split. Apple's weight in the Dow Jones is going to go from number 1 to 15, 16, 17 in that range. And that could start to create this opportunity to see maybe those equities, those bigger, stronger equities want to start to slip. Now, going back to some of the other things that we're looking at when we talk about divergence, like I was saying, those treasury yields, that's always been that major indicator that people are looking at. If treasury yields are strong, the economy is showing strength. And therefore, when the economy is strong, we see these equities continue to kind of do what they do, as John says, they grind higher. When we saw treasury yields start to slip, that's when all the rhetoric started to come out. Timing that is where it gets really tough. And that's when I find that you have to find that catalyst. What's the catalyst that's going to break this thing down? There has to be some sort of big, rough, bad kind of news to ignite this. I'm trying to say that as well as possible. But COVID was that. I mean, that was the catalyst that finally sent these markets down 30+%. And so those are a couple of things that I like to pay attention to. Also, really quick, just want to give a shout out to Tanya, Sarah, and Alan. Good to see you guys.
Hi, Tanya, Sarah, and Alan.
And you're 100% right. It's always interesting to me to see what the actual straw that breaks the camel's back is going to be. It's usually a wayward rogue headline, but this time we had just this massive event and it changed everything,
Absolutely.
But moving on, Hogue, we know that you're the resident volume profile master. What sort of divergencies are you looking for when you're watching volume profile or volume in general?
The auctions, any auction, whether it's S&Ps, gold, or selling brooms, everything is part of an auction process. Volume is a big driver of price. So for like a volume divergence, I'm going to be kind of focusing more on a daily chart. It's more of a longer term look as to how the auction process is actually playing out. So when an auction begins, usually you're going to have a lot of participants trying to buy this product. Let's say the S&Ps have been, maybe not the S&Ps, but let's say, crude oil has been moving higher over time. And the auction began with a lot of volume. You can see the volume bars at the bottom of the chart. And as price continues to get higher and higher, it seems to be drawing in less and less volume. So you've got prices moving higher and volume starting to fall off. That to me is a sell divergence. In other words, it appears as though that upside auction is suffering. It is struggling to continue to move price higher because it's running out of that volume that these auctions need to continue in one direction. So now, not so much if you're looking at the S&Ps or in the equities, the volume really doesn't seem to come in on the upside. You always get the big volume on the downside. So if you're depending on volume divergences in the equities, you're going to have you're going to have a difficult time doing that. But some of your more tangible commodities like gold, like crude oil, they tend to really show those divergences with a little bit more clarity than some of the equities do. Even in some of the grains, some of the meats, some of the tangible commodities, the auction is truly driven by that volume. Now, if you want to watch the equities, you want to watch the volume on the big board. If you're watching the S&Ps and you're kind of monitoring for volume divergence, watch the New York Stock Exchange volume at the end of the day. You start to see that volume start to fall off at new highs and less volume. That's the divergence that I would be looking for. And again, it doesn't mean close your eyes and sell. It means be careful. Start thinking about perhaps selling strength in that market. Don't sell weaknesses. Don't sell bottoms. I've seen the S&Ps chew up shorts for 40 years, and you don't want to be involved in that. So the volume divergence, quite simple. Price is moving higher, volume moving lower over time. Sell divergence. Price is moving lower, volume moving lower over time. Buy divergence.
John, are you looking at a specific time frame on stuff like that?
Typically, I'm looking for buy and sell divergence on the daily time frame because we know that there's very little volume in the overnight. We know that in the S&Ps or in crude oil, the first hour and the last hour are going to accumulate most of the volume. So it's a very difficult divergence to be watching in the day time frame. But sometimes if you're watching it day over day, you're going to be able to recognize, hey, Hogue says this is a sell divergence. We keep putting prices higher over time, but the volume seems to be cutting off. That's not a healthy auction. A healthy auction needs to bring in volume to continue in that direction. When volume starts cutting off, you start looking for a change.
John, I'm happy you brought up the volume. I think that's very important. I'm also happy you specified that you're looking at that on a daily basis. Like some of these oscillators for looking at momentum, I also like that on the daily basis. People who have seen these segments before have likely heard me say, I think day traders make their money catching a piece of the trend for the day. And if you can have the top-down approach where you get an idea of what we might be seeing on a daily basis, or a change in trend, a lack of upside momentum where we might see several days of selling off or several weeks of selling off, the daily is very important because that puts you in a better position to capitalize on the trend for the day.
Hey, Mick, speaking of stochastic here, Tanya's got a question. She says, what's your favorite stochastic indicator? I'm charting on Thinkorswim, and there's a lot of options. Do you have any recommendations there?
It's a good question. My best answer would be for Tanya is to try several of them out. I mentioned I like the oscillators, and you don't need to just have one oscillator. You can set up the time frames of, how many bars are you looking at here? And, one thing you might want to start with is a 5-period oscillator, and then a 10-period oscillator. That will give you one that's kind of faster, showing you quicker reactions in the potential change of momentum or lack thereof. And then, a 10-period will kind of smooth that line out a little bit. So, you could maybe, one could indicate to you this change in momentum might be starting, where another one might be kind of confirming, hey, it's been a longer period of time. We really have seen a turnover in the momentum, and that might give you one might help you catch a move earlier, where one might help you with your confidence levels on, hey, we've actually, began to, lose momentum and make a turn in this market. So I think it's a great question. I would say start out with maybe 5 and a 10. If you feel like throwing a 15 on there to even have a smoother line, that's not a bad idea either.
Awesome. We got John. I'll kick this one to you. DJ asks, "Hey boys, what time frame you looking at for intraday catching the trend?"
Me or JD?
Yes, you, John Hoagland.
Okay, what's the question again?
Taking a nap
I
over
swear
there?
I was not in the Bahamas just a minute. Just repeat the question for me.
Yeah, you're looking a little pasty to be in the Bahamas. DJ asked, "Hey boys, what time frame are you looking at for intraday catching the trend?"
Intraday catching the trend. Well, I mean, there's any kind of time frame charts that some of us are going to use, some of us are going to be different. I tend to stick towards the 30-minute chart in the market profile. I start weekly, daily, 30-minute profile, and in the auction process that I can kind of recognize in the profile, I can sometimes pick out a pretty decent day time frame trend. Of course, I'm always just looking to take my bite out of the middle of it. But there are people that, and that's just me. I know that there are other people that are looking for a 15-minute opportunity to look for supply and demand zones. There's a million ways to skin a cat. Me particularly, I rarely go below a 30-minute chart. A lot of people are like, "How do you do that?" And it's just the way it's congruent. It's consistent with the market profile. So that's why I choose that 30-minute chart.
Just to add on there too, I think when you look at the 30-minute chart gives some really clean levels to look at. That's something I've personally just found. Looking at 30-minute charts, my levels are a lot clearer when I'm looking at those charts on a smaller time frame. And then just to add on there, I'm also looking at a 4-hour just for some acceptance. I like the 4-hour. It gives me a little bit higher time frame that I can still utilize within that intraday day trading opportunity.
There's a lot less noise in those charts too.
Yes.
If I could offer a little insight as far as, how to catch a piece of the trend, or what you're defining as catching a piece of the trend for the day, we have 3 directions a market can go on any given day: up, down, or sideways. Really, the up and the down portion of it, that's a trend, unless you're saying we're trending sideways throughout the day. I think, on any given day, we could, continue trading straight up, or, we could continue trading straight down. As, anybody who's watched the markets knows, we could rally all morning and then sell off all afternoon. So you really have, 2 trends. But if you look at the day in a snapshot at the end of the day, and you end where you started, maybe someone would say that's not a trend for the day. We closed flat right where we started. But other people that are, trading intraday on a shorter time frame could say, hey, we had 2 trends today. One was up, one was down.
Right.
What I would suggest traders do is look at a daily chart. What's your overall trend? Are we going higher? Are we going lower? Or are we going sideways? And then 2 very important price points on the day, and I would say the most important price points of any given day. And Danny, we did a segment one time when you were out, and I said Danny would disagree with this because I know Danny likes settlement price. But I personally think that, the 2 most important price points of any day are the previous day's high and the previous day's low. And I say that because when you trade towards a previous day's high or a previous day's low, you are going to be, trying to determine, are we going to test and reject this level, Or are we going to trade through this and get some, range expansion, where, that could help you catch a piece of the trend, where if we're trading lower, we take out the previous day's low and keep going. Well, we're trending down now on an intraday time frame. So that's one way you could look at it.
Hey, just to clarify, those would be in my top 3 levels to look at. Number 2 and number 3. I would say number 2A and number 2B. But I still got to start with settlement price.
I did say we have different backgrounds in the business. So, rightfully so. It's good to have, be somewhat close on that, but it's okay to be different. Everybody has their own strategy.
Yeah, no, I totally agree though. They help kind of define a little bit of a range. They help kind of frame things out when you're getting started. And I would have to agree with you 100% there. They're very important levels to watch, and just paying attention to how that market reacts around those levels.
And all of this is completely contingent on context.
Yep.
I love it when we get to segue into your guys' favorite topics. That was great. Thanks, everyone.
We have one more question here. Real quick, just want to shout out level 2, Nick and Subconscious. Good to see you guys. Sarah wants to know, do any of you guys use MACD Divergence? I'll just say real quick, can't remember the last time I looked at MACD.
I don't have them up either.
No, doesn't mean that you can't use them. Something I've tried looking at before. Just nothing in my current toolkit.
Mine neither. And again, to kind of reiterate what Mick says, doesn't mean that it's not a useful tool. All of these tools in the right context and at the right time are useful. None of them are always useful. So if it speaks to you, there's no reason why you shouldn't be looking at it.
100%.
Yeah, just to add on that too, it's all about consistency. So if you find something that, creates good probability in your trading, and stick with it. Don't be bouncing around. If you have a couple bad days or didn't work 3 or 4 times, that's totally okay. Be consistent. And here, this is a Hogue term. Be consistent in the lens that you view the market.
Yeah. If you're making money using an indicator that, the 4 of us aren't using, well, good for you. Keep using it.
If you want consistency, bring consistency.
Boom. One more question here. What are some of the indicators you guys have on your charts? I'll go. I've got whole moving average. I really enjoy that one. Then I run a couple other moving averages as well with the EMA. Lately, I've been looking between the 20 and 50 period, as well as the SMA there. And then I use brain fart VWAP with the deviation to the high and low side there. And then obviously on the bottom, I have my volume.
Kind of already volunteered this. I use a couple moving averages and I use a couple oscillators. I played around with the time frames on both those moving averages and oscillators. John's a big market profile guy. I love the market profile. I don't use the actual market profile indicator, but I really like looking at a daily chart for congestion areas, which, if John were to look at his market profile and I tried to, pinpoint an area, high value node like the market profile will show you, we'd come very, very close on that. I find those congestion areas to be very important, whether it's a magnet for a market that's above or below that congestion area, or, an area that could play out as some sort of support or resistance, to be determined in hindsight, never ahead of time.
So I use a tachometer, a speedometer, a thermometer to see how hot the engine is. 30-minute chart, market profile, a couple whole moving averages, VWAP with the standard deviation, and the 20 and, well, depending on the time frame, but if it's on my 30, I like the 20 and the 50 exponential moving average.
Yeah.
Oh, and I should. Oh, go ahead, JD. Sorry.
Oh, sorry. I'm just going to throw out. Yeah, I love moving averages too. I've got a handful on my screen. I cross over between simple and exponential moving averages. I have one slow stochastic oscillator on there that I glance at every once in a while, and then some volume bars on the bottom. So I keep it pretty simple, just like everybody else,
Mm-hmm.
Put up there what you understand.
Yeah.
I would agree. I think simplicity is key. I think for myself, if I have too much on there, I can get lost really quickly. And also there's not enough colors to differentiate everything I've got going. I'll put on there. If I can't find a color that doesn't resemble something else, I have too much going on.
Oh, I also keep a silver dollar at my desk. Heads, I buy it. Tails, I sell it.
I have this little speed bag here, so while I'm nervous, I can fight hit the speed bag.
You pick on something smaller than yourself.
Yeah, absolutely. Inanimate object.
Well, guys, I think we've drifted far enough away from the topic. So I'm going to close this out with a little disclaimer and just touch on something that Hogue said earlier. Divergence is not a holy grail and should be used in concurrence with other indicators because overbought conditions certainly do not mean that you are at a top, and oversold conditions certainly do not imply that you are near a bottom. So keep that in mind also. Now, Hogue, you want to take us home with a quote?
I got the quote.
Oh, go ahead.
Quote today.
All right. So our quote today, I thought this was kind of fun. Divergence. We're talking about mixed signals. I started searching for some quotes along mixed signals. Most of it has to do with a relationship. But I did find one that I kind of liked and it kind of stuck with me. Don't let mixed signals fool you. Indecision is a decision.
That sounds a lot like don't let mixed signals fool you.
I
You need to emphasize the ext.
I thought that's what he was saying.
It sounded like it to me. Don't let my signals fool you.
Yeah.
Well, thank you for that, Dan. Solid advice as always. Now, Hogue, you want to take us home?
I was reminded by one of my dad wisdoms that I put out there once in a while, and I'll never forget. He told me, he says, "You know what, son, I could double my income and only work 3 days a week. The problem is I can't pick the right 2 days to take off when I'm going to lose money." Take your time, be patient, get out there and profit, trade well. We'll see you next time.
See you next week, everyone.